Hello friends. In the previous class we have discussed about the capital structure in the banking. According to the previous class, as per the Basel standards, the capital structure is divided into three categories. One is Tier 1 capital, and the second one is additional Tier 1 capital, and the third one is Tier 2 capital. So we have already seen what is meant by Tier 1 capital and additional Tier 1 capital and Tier 2 capital. Now coming to the main need of Tier 1 capital. The Tier 1 capital, technically it's a going concern approach. What is this going concern approach? Going concern approach is nothing but, suppose if a bank is going to incur any kind of losses, or if a bank having any kind of symptoms towards bankruptcy, at that moment of time, without disrupting the regular banking activities, it will help the banking industry, that means the entire bank. So it's a going concern approach. Now coming to the Tier 2 capital. Tier 2 capital is nothing but, it's a gone concern approach. What is this gone concern approach? That means it appears after completion of entire moratorium. That means whenever there is a possibility of liquidation of the bank, then this Tier 2 capital comes into limelight. Till that point of time, this Tier 2 capital didn't come into the limelight. So that is the basic difference between Tier 1 capital and Tier 2 capital. So that's why Tier 1 capital is very much essential for the health of the bank. This Tier 1 capital is called core capital. So now we have already seen whatever the Tier 1 capital, Tier 2 capital, additional Tier 1 capital, how much amount is required to maintain with respect to the risk weighted assets of the bank. We have already seen. We declared that as per the Basel standards, the CRAR must be minimum of 11.5%. So now we will see why it is 11.5%. We will see in detail with a representation.